Dividends, the true earning power of a stock. Have you ever scrolled through a stock screener and seen the term, dividend yield, and wondered what it meant for your potential investment? You are certainly not alone. While dividends themselves are straightforward cash distributions companies make to shareholders, dividend yield adds another layer of understanding, making it a valuable tool for income-focused investors. Unpacking dividend yield, it's all relative. Imagine you buy a share of stock for $100. That company distributes a yearly dividend of $2 per share. The dividend yield takes that $2 dividend and expresses it as a percentage of the current stock price. In this case, the dividend yield would be 2%, $2 dividend $100 share price asterisk 100%. But why express it as a percentage? Because it allows you to easily compare the income potential of different stocks across various price points. Is there a golden dividend yield number? Not quite. There isn't a one-size-fits-all answer when it comes to a good dividend yield. A range of 2% to 6% is generally considered attractive for income investors. However, this headline number shouldn't be the sole deciding factor. Here is why. Company track record. A history of consistent dividend payouts is a strong indicator of a company's financial health and commitment to rewarding shareholders. Look for companies that have a history of increasing or maintaining their dividends over time. Industry standards. Different industries have different norms when it comes to dividend yields. For example, utilities, known for their stable cash flows, often have higher dividend yields compared to high-growth tech companies that might prioritize reinvesting profits back into the business for future expansion. Growth potential. While a high dividend yield can be enticing for the income it generates, it's important to consider the trade-off. Companies with hefty dividend payouts may be prioritizing returning profits to shareholders over investing in future growth initiatives. This could limit the stock's potential for long-term price appreciation. Let's make it real. A dividend yield example. Say you invest $10,000 in a stock with a 4% dividend yield and a $100 share price. This translates to owning 100 shares, each paying a $4 dividend annually. 100 shares asterisk $4 share is equal to $400 total. That's an extra $400 a year trickling into your account, just for owning the stock. Dividend versus dividend yield. Know the difference. It's important to distinguish between the terms dividend and dividend yield. Dividend, the actual dollar amount a company pays out per share, typically on a quarterly basis. Dividend yield, a percentage that expresses the annual dividend payout relative to the current stock price. Think of it like this: the dividend is the absolute amount of money you receive, while the dividend yield puts that amount in context with the current price of the stock. Calculating dividend yield, a simple formula. The good news is that calculating dividend yield is a breeze. Here is the formula. Dividend yield is equal to annual dividends current share price. Annual dividends. This is the total dividend paid out per share over a year. To arrive at this figure, you might need to multiply the dividend per share by the number of times the dividend is paid annually, quarterly, biannually, etc. Is a high dividend yield always better? Not necessarily. A high dividend yield might seem like an obvious advantage, but it doesn't guarantee future success. The dividend comes from the company's profits, and a high payout ratio, dividends distributed as a percentage of profits, could signal that the company is prioritizing short-term shareholder returns over reinvesting in growth opportunities. This could limit the stock's potential for price appreciation in the long run. Dividends, a double-edged sword. While dividends can provide a steady stream of income, they can also be a double-edged sword. Here is a quick breakdown of the pros and cons. Pros: generate income, hedge against inflation. Rising dividends can help offset inflation's impact on purchasing power, indicate financial stability. Consistent dividends suggest strong cash flow. Cons: limit growth potential. Companies prioritize payouts over reinvestment, attract income-focused investors over growth-oriented ones, might not be ideal if long-term capital appreciation is your goal, taxed as ordinary income, unlike capital gains from stock price appreciation. The key takeaway: it's all about context. Dividend yield is a powerful tool for income investors, offering a way to compare the income potential of various stocks. However, it's just one piece of the puzzle. Consider a company.